Thanks for coming out to our stockholder meeting. Today we will be talking about a company known as Grainger. Fortune 500 industrial company that was founded in Chicago in 1927 by William Grainger. This company was founded in order to provide customers with a consistent supply of electric motors. Grainger became a publicly traded company in 1967 and provides products to customers such as motors, lighting, material handling, fasteners, plumbing, tools, and safety supplies. Revenue is generated business to business rather than in retail sales. This company has expanded from the U.S. to delivering its products to more than 160 countries worldwide. Grainger has expanded its products line over the past 85 years to over 1 million products and repair parts that customers are capable of ordering online or from their catalogs. Grainger is a profitable corporation that has increased dividends to its shareholders for 36 consecutive years now. The company has continued to consistently grow after becoming public and passed $1 billion in annual sales in 1984, and sales in 2004 passed $5 billion. The company has a generous profit-sharing plan where employees with 5 years of service have 20% of their pay added to their retirement plan. This company was named one of the top 100 companies to work for in 2013 by Fortune magazine. Now we will have a member of our team talk about the balance sheet.
About the Grainger, and I'm really good at this. So, Grainger firmware analysis involves using data from balance sheet apart from other statement to develop a business. This company indicates an asset turnover ratio of $1.7 million and debt to equity ratio of 0.89 million. Grainger revenue was $9.97 billion and operating cash flow was $989.9 million for the same period for 2015. Assets can be three types of assets: current assets, fixed, and other assets, which can also include intangible and advanced assets. Typical, most of the internet companies do not have lots of assets. That is not much of an investment such as machinery, equipment, and more to it. Grainger had total asset of $5.86 billion. Total liability for Grainger for 2015, $3.51 billion. Liability for this company like indicate bank loans, service, which have been available for which is settlement in form of cash, assets transfer need to be done in future years. The firm take an obligation to grow its business, which turn to generate economic benefits for its business. The company current assets is $3.48 million. That value, the value came from the year for 2014 and 2015. And the company's account receivable was $1,209,641, which has been increased their accounts since 2015 with a lower amount in 2014. Grainger allowance bad debt in 2014 and 2015 was $22,000 and $288 in 2015, and in 2014 it was $22,000 and $121. It has been increased in 2015 since they have a bigger allowance. There are two examples of footnote: recording intangible assets and goodwill. The assets which will affect the amount of amortized expenses and possible impairment write down in future period. They perform two-steps impairment test which will carry the value of assets of the reporting until it will calculate the fair value. Second step is to perform which the implied fair value of goodwill is compared value of goodwill to determine the amount of impairment. Total current liabilities are $1,788,000 and $534. There are two types of liability. There are short-term debt and accrual compensation and benefits. Their values for short-term was past year and 2015 was $353,000.72, and 2013 was $56,896. Accrual compensation and benefits were in 2015 were $196,667. In 2014 it was $191,695. The reason of the changes in this amount for the prior year was because the accounts were added into liability, which has been increased since because the income tax payable and the trade accounts payable has been added to the account. And that's how the most possible reason that has been increased for the prior year for 2015. Company has a long-term debt was $1,388,414. The company did not show what type of debt what kind of debt was in the balance sheet. Company stockholder equity and total stockholder equity was $221,091, and total stockholder equity was $2,265,634. And Grainger retained earning was $6,802,130. The routine referred to the earning after paying out dividend. Company with increased retained earning is good because it means that company is staying constantly profitable. If Grainger has a yearly loss, this number is subtracted from retained earnings. Thank you. All right, next step is we're gonna move to the income statement.
For all you new investors, I'm going to represent the income statement. The income statement is a financial statement that measures the company's financial performance over a specific accounting period. Today I'm going to go over 4 basic key components to the income statement that will help you choose whether or not you would like to invest in the company. For the first aspect of the income statement, we calculated the gross profit for this year and the previous year. The gross profit for 2015 was $4,231,428 with a 43.2% ratio. The gross profit ratio for 2014 was $4,314,242, which has a 44% ratio. So as we can tell, in 2015, it decreased the amount from last year since other expenses have been added into the account. All right, now moving on to our second step, we have earning per shares. These are very important when investing because it's the amount of money that you're going to pay per share. For 2014, we had an estimated $11.59 per share. And then for 2015, it actually went up 10 cents to $11.69. This is good for the company. It shows that it has increased its sales for 2015 and shows that the public thinks the company is worth more than it was and is continuing growing. For our last and final aspect of the income statement, we have the company's current stock price and then the calculated price to earning ratio. The current stock price for Grainger is $228.03, with the price earnings ratio of $19.62. The price to earnings ratio tells us that per $19.62 of an investment, an investor wants to get back $1 of the current earning. And that is all for income statement. Thank you. For our next representative, we have the statement of cash flows. Thank you.
Hi, today I'm going to talk to you about the statement of cash flow to summarize the effects of cash or cash equivalents. I'm going to break down operating, investing, and financing activities. Starting with the net earnings, which is the sales revenue left over. In 2015, we had $785,174. The impairments of goodwill and intangible assets, which in 2014 we had 0, indicating that we impaired no loss or bad press. But moving on to the most important part, where we get most of our cash flow. In 2015, our operating activities was 989,904. And then our cash flow from financing activities was 843,358. All this indicates is that we made a profit, and not only did we make a profit, our cash flow came from operating activities, which means that we made a revenue, which not only did we invest back into the company by purchasing treasury stock, we also paid out dividends to our investors. So, in summary, Grainger Incorporation is just not a company that you should look at the numbers, because numbers can deceive you sometimes. We have a great foundation, we have great culture here, and our account receivable turnovers are very low. And then our equipment depreciation is very low, meaning that we don't have to buy new equipment anytime soon. We have very little long-term debt, and our equity is great. And what I'm trying to say is that this is a great company to invest in. Next, I would like to have our accounting policy representative come and give you some more information about accounting processes we have. Thank you.
Today I'm going to be talking about Grainger's policies, and the first one is cost of merchandise sold. The cost of merchandise sold includes products and product-related costs, vendor consideration, freight out, and handling costs. The company defines handling costs as those costs incurred to fulfill a shipped sales order. Next is reclassification, and that is a certain amount in the 2014 and 2013 financial statements, as previously reported, have been revised to conform to the 2015 presentation. These changes did not have a material impact on the presentation of the consolidated financial statements. Finally, the principles of consolidation, and the consolidated financial statements include the accounts of the company and its subsidiaries over which the company exercises control. All significant intercompany transactions are eliminated from the consolidated financial statements. We think this is a good company to invest in because they have great stock prices and turnover ratio and good cash flow. Still a rapidly growing company all around the world.